All right, we're going to pull back the curtain on a part of the stock market that most people have never even heard of. It's a hidden world where billions, with a B, of dollars change hands every single day, completely off the public's radar. This world is quietly reshaping how all of modern finance works. So let's dive in.
So what if I told you that this number, over 50%, represents the amount of all U.S. stock trading that doesn't happen on public exchanges anymore? You know, the New York Stock Exchange, the NASDAQ. Nope. For the very first time in history, the majority of trades are now happening completely off exchange, in the dark. I mean, that's a huge shift in how markets operate, right? So it just begs the question. If all that trading isn't happening on the public exchanges that we all know and see, then where in the world is it? Well, the answer lies in a network of private venues with a name that's pretty fitting. All of this hidden trading is happening in places called, you guessed it, dark pools. So what is a dark pool? Well, think of it like a private stock market, a members-only club. Unlike a public exchange where everyone can see the buy and sell orders popping up in real time, in a dark pool, those orders are totally invisible. The details of the trade, who bought what and for how much, only get released to the public after the deal is already done. Okay, so why would anyone want to trade in the dark? I know it sounds a little sketchy, right? But there's actually a very specific, very big problem that these pools were originally designed to solve for some really, really big players.
Okay, imagine for a second you're running a massive pension fund, and you need to sell, say, 1 million shares of Apple stock. If you just dump that huge sell order onto a public exchange, everyone sees it instantly. And what do you think happens next? Other traders see your move and they start selling ahead of you, driving the price down before you can even finish your trade. That's called market impact, and dark pools were created specifically to avoid that problem.
And this chart right here, it really breaks down the fundamental trade-off. A public exchange, what we call a lit market, gives you pre-trade transparency. You see the orders before they happen. A dark pool does the exact opposite. It only gives you post-trade transparency. But the real prize, the reason people use them, is that execution price. A lot of the time, dark pools can match a buyer and seller at the exact midpoint of the public price, which can mean a much better deal for both sides.
So who's actually running this hidden marketplace? You might think it's some single shadowy organization, but it's not. It's a whole ecosystem run by some of the biggest names you'd recognize in finance.
Yeah, they basically come in a few main flavors. You've got pools owned by the huge banks, like Goldman Sachs, where the bank itself might actually be trading against you. Then you have these neutral agency brokers, like LiquidNet, who are just acting as matchmakers. And here's the ironic part. Even the public exchanges, like the NYSE, run their own dark pools. They're trying to capture the very business that's leaving their main lit markets.
And this, right here, is where it all gets pretty controversial. Because when a big bank owns the pool, they can see all the orders. And that creates a massive potential conflict of interest. Are they really trying to get their clients the best price, or are they using that secret information to make a profit for themselves? Or worse, are they selling special access to predatory high-speed traders? So this brings us to the real heart of the debate, right? Are dark pools a necessary evil, a useful tool for big investors, or are they a genuine threat to the fairness and the transparency of the entire market? Now, check this out. Here's a fascinating, kind of counterintuitive idea. Some researchers argue that dark pools actually help the public market. The theory goes like this. So-called uninformed traders, like that pension fund that's just rebalancing its portfolio, not trading on a hot tip, they go to the dark pools. This forces the informed traders, the ones who think a stock is about to pop or drop, to trade on the lit exchanges. The result? The price you see on the public market might actually be a cleaner, more accurate signal of a stock's true value.
But there's a catch, and it's a big one. This chart shows the tipping point theory. The idea is that while a little bit of dark trading might be healthy, once too much trading volume moves into the shadows, and some studies put that number around 40%, the public market can become thin, unreliable, and just broken. And remember where we started? We're already way past that point.
So a degrading market is a huge systemic risk. But for anyone actually in a dark pool, there's a much more immediate danger. It's like swimming in the ocean and realizing there are sharks in the water.
So here's how the hunt works. These high-frequency trading firms, HFTs, they use super-fast algorithms to send out thousands of tiny little orders into the dark pool. They're called pings. It's kind of like a submarine sending out sonar. They're probing for something big. As soon as one of those pings gets filled, bingo, they know they've found a huge hidden order. And in a nanosecond, they race over to the public exchanges to buy or sell ahead of that big order, profiting from the price move that they know is about to happen.
And look, if you think this sounds like something out of a sci-fi movie, it is absolutely not. Regulators have been cracking down. In one massive case, 2 huge banks got slapped with over $150 million in fines. Why? Because they were essentially lying to their clients, telling them their dark pools were safe while they were secretly selling VIP access to these predatory high-frequency trading firms.
So where is all this headed? Well, this hidden world isn't just sitting still. It's constantly changing. It's a high-stakes cat-and-mouse game between regulators, traders, and, of course, technology. And right now, the rulebook for traditional finance is basically in limbo. The SEC has passed new regulations to try and even things out between the lit and dark markets, but those rules are all tied up in court challenges. It's created what some are calling a regulatory purgatory, where nobody is quite sure what the rules of the game are going to be.
But while the regulators in traditional finance are stuck, innovation is not waiting around. In fact, the next evolution of the dark pool is already here, and it's taking shape in a whole new financial universe, the world of crypto. See, on a public blockchain like Ethereum, every single pending transaction is visible to everyone before it gets confirmed. This creates the exact same problem we saw in the stock market. Super smart bots can see your trade coming and jump the line to front-run you. In the crypto world, they call this maximal extractable value, or MEV.
And this is where the future gets really, really interesting. New crypto dark pools are being built with a mind-blowing technology called zero-knowledge proofs. The best way to think about it is it's like being able to prove you know a secret password without ever having to reveal the password itself. When you apply that to trading, you can match a buyer and a seller without anyone, not even the person running this system, knowing the details of the trade until after it's done. The operator is literally cryptographically blind. That whole conflict of interest problem, poof, it's gone. And don't think for a second this is just an American thing. This move toward dark trading is going global, and it's happening fast. We're seeing huge growth in markets like Japan, and brand new dark pools are being built for emerging markets all across Europe, the Middle East, and Africa. It is a worldwide shift. So here's the real takeaway from all of this. Dark pools aren't some weird fluke or a temporary trend. They are a permanent, structural part of our modern, high-speed electronic markets. They're a logical response to the problem of trying to trade huge sums of money, and they are constantly evolving to offer ever greater levels of stealth.
Which leaves us with one final and frankly pretty critical question. As more and more of the world's trading activities slips out of public view and into these increasingly sophisticated shadows, how can any of us be sure that the prices we see on the public market, the ones in the light, are still telling us the truth?